That was the big aha moment. If you make a stronger bottom line, the impact's stronger. If you make impact, the bottom line's stronger. It's not separate. Basically, from that moment on, I was chasing this idea of what other investments can I make in this world, and how do I learn as much as I possibly can about impact investing. We have this mantra around organizations and individuals have kind of three categories and buckets they think of: their purpose, their passions, it's their legacy. And frankly, from my perspective, sustainable and impact fits perfectly into every single one of those lines that I just said. I'll tell you what nobody wants is us to come and say, your ESG score is a 7 compared to your benchmark of a 6. You're doing a great job. Nobody wants that. Put yourself in a courtroom 100 years from now with a future generation that has not been born. And they could be saying, I didn't ask for this crazy impact stuff. What is this? And we could get sued actually 100 years in the future.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Mark, nice to meet you. Thanks for coming on today.
Thanks for having me, Scott. I'm excited.
Before we dive into the business side, I want to understand the human side first of your story. And I always believe that understanding someone's origin story is crucial to understanding who they eventually become. You grew up in Philadelphia with a mother who was a teacher, a sister who was also in education, and a father who ran a small local business. What was the energy like in your household? What experiences did you have, or what kind of conversations maybe were happening around your dinner table that you think shaped your relationship with money and business and made you the man that you would eventually become?
A lot of the conversations around the dinner table, and I think what was ingrained in me really early on, I would say two different dimensions. One was definitely work ethic. Both my parents came from a very blue collar background, and this idea of working and learning the value of money from a really early age was definitely ingrained in us. Even the chore charts that I used to have to fill out, I'd get like a coin for each one when I was really little. And then I remember I wanted a Sega Genesis. For those listeners that remember the Sega Genesis, it was a great video game system at the time. It was like go out and sell lemonade or figure out a way to pay for that then, and then it was getting jobs parking carts at age 14, at one of the local golf courses. And then it was working as a cashier. So all the way through, I think that was important. I think the other thing though, which is kind of higher level, was this idea of community and giving back and finding your way to do that. So like I mentioned, my dad was running a local business and was always really involved in community events, kind of that angle of it. My mom was a school teacher, and that was her way of giving back. And I think my mom always tried to tell me was, whatever you do, kind of find your talent, find what you love and what you're really good at it, but find a way within whatever that job is to always give back in your life. That steered me absolutely. It took some time, but into where I ended up on the sustainable investing side.
And what kind of business did your father have?
It was a local golf course, more like a municipal course, if you can think of that, cool. Right? So his dad ran a farm, and in the 1960s started to convert it year over year into this local course, just again, as this municipal course that anyone could come out and play. There was no private membership whatsoever, right? It's very affordable to come out. And my dad then took that over and kind of ran the day-to-day of that local business, right? Super small, one location, anyone can play, and a lot of community events around it.
In my research, I found something where you said that you watched CNBC and was fascinated by the financial market talk when you were a kid. How young were you, and when did that start?
3rd grade. And it was because of a school project. It was a teacher, Mrs. Peterson was her name. And it was this business part of the 3rd grade class where they said they wanted everyone to pick a stock and they wanted everyone to come back with why. And then we tracked that stock over the entire course of 3rd grade. And my stock was Scholastic, which you can imagine as a kid, it was a kid's book business. And
Scholastic Book Services.
It tanked. I think it lost 60% of its value. And I remember having to present that stock chart, right? And kind of embarrassed, saying, well, and look, I was just really interested in this whole concept really early on. And I think why is because I was this crazy, insanely curious kid. And I also probably had, not ADD per se, but I definitely had a roaming attention span at the time. And I think for me, this idea of the investment world and getting to learn about all these different businesses and how they work and trying to understand them was really appealing to me. And it almost rewarded this intellectual curiosity. I was always confused when people could choose just one very specific thing early on and say, that's exactly what I want to do, because I was so interested in just learning about as much as I could. So it was probably something like that fueled it.
That's awful young.
And Mrs. Peterson, it's her fault, right? I really enjoyed that project in a way that stood out and I still remember, versus a lot of other courses that I was taking at the time, right?
The interest continued.
I always was interested in this. Middle school, I was involved in the investment club. High school, they gave us a little pool of money to help manage as high schoolers. I took every class I could get. And again, I didn't know anything more than that I liked the investment world and I wanted to try to get into it. I didn't have anything more specific in my mind than that.
And high school was Downingtown East High School. I know they're known for sports programs, Go Cougars. What sport did you play?
I played golf. Golf was my sport. It was a great experience. It's still a sport that I love and play a little bit less now. I have 2 kids, but really enjoyed the camaraderie, really enjoyed the mental aspect of golf, I would say. The thing about golf that's so important is it's just you out there and you don't need to worry about your competition. And it's also so important that if you make a mistake, there's this concept in golf of like this goldfish memory where it's like, it's actually critical that you totally can put yourself in a new frame of mind and the next shot is totally new and separate from that last one. And it's really hard to do, but I think frankly, managing emotions and being able to really focus in on exactly what you're doing as an individual, it's a fair way to invest as well.
And then when it came time for university, you chose Wake Forest to study business. What was the decision-making process on that? And what were you thinking about at age 18 in terms of what you wanted your life to look like?
I had a few basics in what I was looking for in a college. I didn't want to be close to where I grew up. It wasn't that I didn't like my childhood, but I wanted my own thing. Something like half the school went to the local university near Philadelphia. I wanted a different network. I wanted a different group and a different experience. 2, I wanted nice weather. 3, I wanted a school that had a great sports program. Not because I was good enough to play any of the sports, but because I am a big believer in what sports does for a community. It's like one of the few things that everyone can rally around. And 4, I wanted a school with a great business and investment program. And Wake definitely had that. It was one of the top business schools from an undergraduate perspective in the country and had a really robust investment program where you could actually get involved and, again, run a little pool of capital that the endowment actually gave to the students. And that really appealed to me.
Was that the entrepreneurship or is that something separate?
Those are separate from the investment club. The entrepreneurship club was something that I actually co-founded because of this idea of how can we as an organization and as a student body try to better understand what makes early businesses great. And it was a really cool way to invite founders and impressive people to come and learn from them, frankly. Because frankly, at the time, I was very interested in investing, but the only exposure I had was large scale public stocks. And I started to get curious on like venture capital and how's that work and how do they understand early companies? And that was kind of the idea around it. And we got some really cool people to come speak. Steve Wozniak actually was the amazing get that we got my senior year. I can't believe he said yes, but we learned a lot from some of the people that came through.
You graduated from Wake Forest around 2009 and landed at Cambridge Associates in Boston. Now that's pretty specific corner of the investment world, working with endowments, foundations. So what attracted you to go work for Cambridge Associates and what did you think you were going to get out of working there?
I had no idea what sort of investment firm I wanted to work at coming out of school. It was quite the challenging environment because all of my interviews were right in September and October of 2008. So you can imagine how that went. Cambridge was part of that. And what appealed to me, frankly, was a couple things. You know, one, this ability to right away work with really big endowments and foundations and families and pension plans, some of the most sophisticated investors. And the other angle that really attracted me was the amount of asset classes that they covered. Because again, I didn't know what I wanted to do other than I liked the investment world. So they had this central rotation program that's 2 years and then you choose into an asset class where the first 2 years is you're spending 6 months on equities, 6 months on fixed income, 6 months on private equity, 6 months on hedge funds. And then you choose in, you apply, and you get in. And that was a really good way to actually have practical learning on my side. I always encourage folks to try to find firms with rotation programs. The other thing was right away, Cambridge had this great policy where they would let almost anyone come into the room when a leading hedge fund manager or private equity manager would come in and kind of learn from them. I thought that was a really good way to educate some of the junior staff. So that was really helpful. And frankly, where I learned a lot around different ways to invest.
Cambridge Associates was doing some early work in what they called socially responsible investing.
Yeah,
and then they had something kind of mission related investing. Did you get exposure to that? And what was your initial reaction though?
I did get exposure and I wasn't that excited about it, I have to admit, because frankly, this is 2009, 2010. What Cambridge was doing was what most folks were doing, which is they had this mission aligned investing group, but it was all exclusionary. They were just screening out what I would call sin stock. It was a lot of faith-based screens. And it was this general idea and a view, which I share, which is like, you probably won't outperform if you do this. In fact, you're shrinking your investment universe. So you might underperform a little bit, but look, at least you're investing alongside your values. And frankly, that was the opposite of what I was interested in. I was trying to understand all these ideas of alpha generation and what data sets can help you have better returns. And it wasn't particularly attracted to it at the time.
And there was this pivotal moment while you were there, an aha moment involving a South African private equity firm doing off-grid solar projects. So tell me about that.
That was right after I left Cambridge. And actually, when I joined OMERS, OMERS is one of the world's largest pension plans. It serves municipal employees of Ontario province. So it's firefighters, it's police officers, right? It's those folks. And it's about $100 billion. And they brought me in to be part of a 5-person hedge fund and private equity team to build out that exposure as part of OMERS. And it was such a cool remit because they're like, we want stuff that's really esoteric and unrelated to everything we're doing in the long only equity and long only fixed income part of the business. We want things that are uncorrelated, that are unique, that are going to deliver just absolute returns. And one of the earliest investments that I got to work on there was this South African renewable energy related private equity fund investment. And what that fund was doing was they were looking at this idea of leapfrogging. So this idea of they've really never had a consistent grid for traditional energy there. A full scale renewable build out would be prohibitively expensive and really tough to navigate there. So they were looking at what we call off grid solar. So this idea of, really locally driven solar projects that can power a small business or a small town in parts of the world that don't have consistent access to affordable electricity. And I was writing these investment memos, which was my job, basically writing these investment memos on interesting hedge fund or private equity investments. And I still remember they had what was called this double bottom line return that they were talking about on their materials. And one line was the financial returns of the fund and what they were expecting, which looked strong. But then right next to it, they had this impact return. And for them, it was number of individuals given affordable electricity for the first time. That was thrilling for me because frankly, I had been searching for this way, going back to your first question around bringing up on like, how do I give back in this? Some of the hedge fund work I did or private equity work I had to kind of ask myself, like, what sort of real value am I adding here? I'm kind of moving things around on a spreadsheet and okay, well, I'm definitely benefiting the firefighters and police officers. This is like the conversation going on in my head, trying to justify some of it, when some of it is some of what some hedge funds do and private equity do. It's earning capital, so they're providing liquidity. There's no question that they're adding value in some ways, but it's also like, where's the business left after it in some ways? And so I was doing all this nonprofit work at night. I was on the board of this great educational nonprofit. And it was this really weird dichotomy where we'd make these $100 million investments during the day. And then at night, I'd be trying to raise $5,000 from some of these same people to support a really strong educational nonprofit. And they'd say, oh, no, talk to my philanthropy person. I don't want to do that. And I'm like, why is this so separate, right? And we did this investment right around the same time. And that was the moment when I said, like, well, what is this? What's this double bottom line investing? What's this world where it doesn't have to be separate? And in fact, the work that fund was doing, which is really important, like they were trying to achieve impact as part of their work, but they were trying to achieve it not just because it was good for the world. They were trying to achieve it because they thought it actually made them a more sustainable business, if that makes sense. The impact they were producing actually helped their bottom line. That was the big aha moment, that these things can be linked and actually can help each other. If you make a stronger bottom line, the impact's stronger. If you make impact, the bottom line's stronger, if that makes sense. It's not separate. And basically from that moment on, I was chasing this idea of what other investments can I make in this world, and how do I learn as much as I possibly can about what at the time was basically referred to as impact investing.
What was driving that? Was there a strong impetus already at OMERS to do this?
Definitely not. Nope.
Who put that on there then? Where'd that come from?
Basically the underlying fund manager that we were due diligencing and looking to invest in, that was based in Africa, they put it on their materials, And as I'm underwriting this, and I'm coming back to senior management and saying, oh, there's also this great double bottom limit. And not that they weren't interested. They're like, well, that's great, right? That's a nice added benefit here. But there was no part of their remit to produce impact as part of the investments we made. It was just truly bottom line focused.
What led you to leave Cambridge to go to OMERS?
Opportunity, location, and ability to really get my hands dirty on the investment side. I was making a move. I really wanted to live in New York, just as a lifestyle, somebody in their mid-20s, that I wanted to be, as I viewed it, as the center of the financial world. Is always kind of a dream for me, frankly, growing up, back to the CNBC days, to kind of be there. So this opportunity was based in New York.
So you weren't in Canada then?
Nope. I was going back and forth a lot. I spent a lot of time in Toronto, but this office, they based in New York intentionally because they wanted folks essentially to be in the flow, as they called it, of all the hedge funds and private equity that's right there. It was also being able to kind of lead the investments, right? At Cambridge, I was going through a rotation program. I was definitely writing research. I wasn't leading investments. It was a jump from that standpoint, more responsibility. And the third point I would say is it was laser focused on alternatives. And that, at that age, is where I was really interested. This idea of all these different ways to produce alpha. And frankly, I definitely looked up to a lot of these people that were leading those firms.
But that only lasted about a year and a half. And then you made a move that some might consider bold by leaving your job to pursue an MBA in the London Business School. What did you feel was missing from your toolkit that you needed to develop there?
It was very specific. I wanted to be a full-time, again, at the time, impact investor. That's all I wanted to do. And talking to my boss, who's still a friend and kind of a mentor, and saying, like, look, that investment we did, a couple of years ago, I want to do those all the time. And he's like, what is this, philanthropy? Like, no, it's not. And he's like, well, a few thoughts. He's like, you might want to go into business school if you're thinking about this kind of pivot to hone in. And he's like, at the time, he's like, you might want to consider a European business school, because at the time, this idea of impact investing, sustainable investing, really wasn't a term yet. ESG definitely had not come along. Europe was really leading in terms of this idea. And that's why I really honed in on, pretty quickly, a small handful of business schools that had pronounced reputation and programs that were totally about this space. And the goal in my mind was, I'm going to go learn everything I can possibly about all the different ways to do impact investing. And I'm going to come out of school and I'm going to join an impact investment firm. That was the thought.
And then you got out and you landed at Flat World Partners, which was also in London. So explain what Flat World is and how did that opportunity come about and what you were doing there.
Think of it as a tiny version, almost a startup version of Cambridge Associates, meaning we were trying to work with individuals, families, endowments, foundations on discretionary management of their entire investment portfolio, going out, finding strategies to invest in, and again, working with those clients. The big difference was we were only going to be doing that on impact investing. So this was one of the earliest firms that was truly only focused on impact investing from this kind of, outsourced chief investment officer dimension, just building out these investment strategies. So what I was doing, I was leading all of our, what we call manager research. So my job was to go out and find the top tier public managers, private managers, and to develop a way and a lens to say, which ones do we think are actually producing strong, tangible, measurable impact in a way that also helps them generate higher returns, and which ones aren't. It was this early idea of which ones are greenwashing, saying they're doing something impactful when they're not, and which ones are not. And it was a really fascinating time to be in the market, because it was just at this early stage of a lot more people starting to talk about it.
This is where you kind of cut your teeth on manager sourcing, but was this across multiple asset classes?
It was supposed to be across all asset classes. I mean, our goal was to build total portfolios that could achieve impact in areas like climate or health or education or whichever area that our client base was looking at the time. This is called 10 years ago. Most of the opportunities were in private markets, venture capital, private equity funds that were honing in on one theme. There were some public equity strategies that were out there. They were typically pretty broad, meaning not one theme. And they were still predominantly exclusionary. This idea of we're just going to exclude out a lot of companies that are not aligned with your values. I wasn't seeing that much yet of this idea of, well, we can link really interesting data to identify companies that are strong from an impact perspective, and that helps them be stronger businesses. I wasn't seeing that much of it yet. There were only a handful of funds, and most of them were in Europe, frankly.
What was the toughest due diligence deal killer you encountered, and what did it teach you about distinguishing between glossy SDG pitch decks from someone producing real impact?
There was one really specifically that I think taught me a very valuable lesson that ended up, I would say, failing from my perspective, that we did make. So this was an investment that was emerging markets focused, and that the concept was, it was a private equity firm, and they were going to be scaling a European olive oil business into large swaths of Africa that were heavily reliant as their core kind of food input on palm oil. And their impact idea there was, well, palm oil is very bad for you from a health perspective, and it's also terrible for the environment to produce palm oil in most cases. There's some exceptions. So great impact story, right? And then of course the business sense, olive oil is this great input, and they were going to buy a really cheap Spanish olive oil company, bring it down there. Everybody wins, right? The investment absolutely failed from, frankly, both dimensions, but more on the impact dimension. And the reason is because when looking at the impact story, yes, it improves health. Yes, it improves the environment. But what does replacing palm oil with olive oil do to the livelihoods of the people in those towns that are actually predominantly working in the palm oil plantations? And I think that wasn't considered well enough from an impact perspective. We had a very strong thesis on the environmental side. We had a very strong thesis on the health side. We hadn't properly factored in job creation and unintended consequences of this investment that could actually erode the overall impact of it. I think that taught me a very valuable lesson of these terms, externalities, which is a fancy way of saying other effects on this investment that we hadn't considered. It taught me a valuable lesson on net impact. Don't just focus in on one theme, but think about overall consequences across the board. And frankly, what they ended up doing is, I think, a few other investors recognized this a couple of years into the life, and they ended up pouring a lot of money into this idea of retraining the folks in those areas to work in palm oil plantations, to instead work on localized olive oil plantations. That was their fix, which made the investment, again, it made it still profitable in the end, but the IRR absolutely eroded because of this larger expense side that they hadn't considered. So that was one that's always stuck out to me. And ever since, I've always spent a lot of time on this idea of net impact and understanding externalities.
Making sure that there's real impact as opposed to greenwashing. But you've also said that impact without sound economics is really like philanthropy. I'm paraphrasing, and not really investing. Was that something that you derived from after a lesson that you learned at that point in your life, after making a tuition payment into the School of Hard Knocks about something that didn't earn its keep?
I think really early on too, during this period, I started to see a lot of public equity strategies start to come out, because that was where we started to see a lot of the interest more mainstream. And I think really early on, there was this idea of using ESG scores. So MSCI, Sustainalytics are some of the big providers of ESG scores. And a lot of these strategies started to come out that were designed around, okay, we're going to positively tilt towards companies with strong scores, and we're going to negatively screen out ones that don't. And look, those strategies didn't work. And even at the time, a lot of the manager meetings that I would have would fall down by the first simple question that I always try to ask is, why are you doing this? A good answer is because having this additional data or having this priority on impact helps us be better investors. It fits cleanly into our process. These are financially material. Here's how we work them in, and here's how it produces better returns. A bad answer is, well, we're seeing a lot of interest from younger generations in impact, and this is a client offering for those that want it. That's a marketing answer. That's a client strategy meeting answer. That's not an investment answer. And if there's not a really clear vision around why you're doing something and how you're going to use XYZ data set, whatever it is, to help you be better investors, then we're not interested. That it's not a double bottom line investment, in my view.
Is that where you developed your economics before impact rule?
That was where I developed this whole way of evaluating these managers that, frankly, I still use. We tweak it a lot. But the basic concepts of what makes a strong double bottom line investment manager remain. It's a few categories that we're looking for. It's a whole set of questions. I think I started out with 20 questions that we always asked. I'm up to, I think, 72. So we need to probably start cutting questions, frankly. It's too much. That has served us really well to kind of pinpoint. And frankly, it served us really well ahead of when this space exploded, which we'll get to, when the SEC started asking a lot of questions. A lot of the questions they were asking were questions we've been asking for a long time around trying to assess greenwashing versus what's real.
A couple of years later, around 2018, you made another big move, this time to JP Morgan Asset Management, back to New York, but as VP of Sustainable Investing this time. That's going from a boutique impact-focused firm to one of the world's largest asset managers. So what was the idea behind that?
Yeah, it was an interesting idea. And I like to say I eventually found kind of the sweet spot. But I went from a really little boutique with this idea of like true impact. We're going to really do this. I was a little bit, I would say, disappointed or felt that I could be doing more by just how slow the traction was at Flat World and how we were really struggling to get up the spectrum. We really struggled to convince larger families or endowments or foundations to invest in us. We were trying to convince them of two things. One, that this can be a real space that's not concessionary. And then if we convinced them of that, it was, and invest a bunch of us that you've never heard of and are really young and have this cool office space, right? And it's like, they're like, yeah, that's great. We like the impact. We're going to go to a big firm and we're going to do it there. So I started to really get into this idea of how can I make the biggest impact? Is it every single dollar is 100% impactful, but it's only so many dollars? Or is it lots and lots of dollars? And maybe it's 70 cents of impact on the dollar, right? Maybe it's a little bit less impactful, but it's a lot of dollars. And that's a good way to make a difference. JP Morgan came along, super interesting. And they wanted to hire me to be the first US sustainable investing person in JP Morgan Asset Management. So what an amazing opportunity, right? It's like, wow, this huge. And they had a nice European team, and that's who I was reporting up to, but nobody in the US. And they were saying, we're seeing all this interest across the board in some of their larger clients and some of their more retail clients in this concept. And they said, come in, help us understand how we can integrate environmental, social, governance information factors across all of our portfolios. How can we develop new novel strategies that focus in on sustainability in a more pronounced way? It just was really appealing to me, this idea of one of the world's largest asset managers and being that person that was helping to scale it.
That was still kind of early doors for all this. You were first in the US and something like 20 some investment teams managing $1 trillion of assets. That's a lot of people to convince that sustainable investing is a thing. What did it actually take to make that happen there?
It was a masterclass in something that honestly has been most of the levers of my success, is this idea of how to persuade very skeptical veteran investors that this can help them. This idea of sustainable investing, a masterclass, because they just threw me into the deep end and said, you got to go around and you got to convince all these teams. I was in these rooms that I had no business being in. They say, okay, go into this room with this super senior managing director who's run a portfolio for 40 years successfully for us, and convince him that he should be doing ESG integration, right? It's like, and look, my approach was very specific. After several of just failing, obviously, and going in and trying to convince them on my own, it was, don't let them only hear from me, the ESG guy in quotes. Let them also hear from one of their peers, somebody that sat next to them for a long time, and they also view as a serious investor. So that was point one. So I went around, I listened, and I learned from a whole bunch of people. And over time, I started to find people that did kind of believe in this or did think it had merit. And maybe they weren't that top person, but they were a number two or right there working with them. Convinced them, and I formed this little team. We called it the Sustainable Investment Leadership Team. There's 25 of us. And I said, look, I just love your view. I'd love to test ideas with you around how we could do this. And it was this great group of people that, again, they were kind of one or two layers down. They were excited about this. And what I had is anytime I'd then go meet with the 40-year veteran, the crusty old veteran, I'd bring that person and say, look, I've been working, with John here. And John would then talk most of the time because, again, totally different view of versus, oh, of course the ESG guy thinks I should do ESG. In terms of what we presented, it was two things. One, we led with data. We led with a lot of the studies and the research, mounting research at the time that pointed to this idea that integrating ESG can be not harmful to your return, not even neutral, but actually helpful to your end return. So that was one. We leaned really heavily on the meta studies that were really big at the time. If you remember, Hamburg Institute was a big part of those. And that pointed to essentially this idea that about 90% of the time, looking back to the 1970s, it's either a neutral result or a positive result from integrating ESG information into your investment approach. And it was very well reviewed, peer reviewed, research that was coming out on a regular basis. That was a big aha moment, I think, for a lot of institutional investors, and definitely helped our cause. It gave people this idea, the ability to say, oh, actually, maybe I should be thinking about this, that actually maybe it could help. All this new data that's coming out that's very inefficient and unstructured, if you use it in an intelligent way, maybe that actually could help. And we're not constraining our universe. If that didn't work, I leaned on the sales side. I did. And I would say, here are the RFPs that we've received over the last year from all of the world's largest pension plans, a lot of the US pension plans, a lot of the big endowments, foundations. About 80% of them at the time had been asking, how are you thinking about or incorporating environmental and social? Because this is all something that everyone was looking at the same time. And at the end of the day, it kind of added up. They heard from a peer that they thought was credible. They saw some compelling research that was legitimate, not from us, that pointed that you don't have to give up returns, if you can do this thoughtfully. And then 3, they thought, well, maybe this will help me win some business as well. And that added up to I think, a compelling strategy. I think the other thing I tried to do and be really careful about is like, look, I'm a resource. I'm here to help. I'm here to help with things you don't have time to do. Like every investor, everyone loves data and all says, it's only about the data that I find that's out there that's different and how I uniquely do something with it. And I said, look, I can help you steer you towards some really interesting data sources here. I can help steer you towards a framework to incorporate that. And in the end, it was effective, but it was definitely a school of hard knocks. It definitely was. I still use a lot of those learnings today.
After 2 years at JP Morgan, in 2020, you made the move to Glenmede as Director of Sustainable and Impact Investing. Now that's going from a $1 trillion global institution back to a boutique. So tell me how that came about, what your thinking was then.
The opportunity was tremendous, honestly. I was happy with JP Morgan. We were doing great work. We were making an enormous amount of progress. There were also some challenges, and this isn't JP Morgan specific, but it's any large bank or asset manager like them. And correctly, they have to think about all of the competing business lines and how things go together or conflict with each other. And they also have to manage short-term earnings. And to win consistent, sustainable investment mandates, one does have to have a strong amount of authenticity and consistency in why you're doing this and how. And one also has to have a long-term view and be able to tolerate, frankly, a space that can get really politicized and really noisy. And, the CEO of Glenmede at the time came along, somebody I knew, and, he talked to me. He said, look, Glenmede is a firm that is privately owned and always will be, that takes a long-term view, that believes really passionately in this idea that investing in companies that are producing impact can have a sustainable business advantage. It can help us on returns. And we want someone to come in and be the head of the group and to take some really good work that had already started to happen, but to really institutionalize it, to make it a business, to be able to expand our reach across our client bases, to develop the name of the group, the philosophy of the group, build out a team, be that front-facing person that's out there kind of spurring thought leadership and research, and go out and build out a suite of strategies. And that was a very compelling pitch. I'll also note that, again, since we started with the personal, the fact that they were headquartered in Philadelphia, where I grew up, and my wife, who had been with me throughout the whole time, I should note, even back to Wake Forest, he's like, you could also have a homecoming. We had just had our first daughter. We were in the East Village in New York City, and we had this screaming baby. We kind of looked around and said, like, right? And it's absolutely the best move we ever made, both personally and professionally. So there was a mix of factors with any of these moves, right? And I've done a good job of staying for much longer, and certainly that's the intention here. So, yeah.
This would be a good time for you to paint a high-level picture for us of what Glenmede is today, and just give us some of fun facts, assets under management, geographic reach, and team size. I'd like to know, where does sustainable and impact investing fit within Glenmede's overall business?
Glenmede's a really fascinating firm. So it was founded back in the 1950s by the Pew family. So PEW. So like Pew Charitable Trust, Pew Research. And it's a family that actually earned its wealth from Sun Oil, which is Sunoco for folks in the US listening. And Glenmede was the name of one of their estates outside Philadelphia. And they basically formed Glenmede to be the trustee for their family wealth. So there's one client initially. Then, of course, over time, other families in the area saw and said, this Glenmede thing's doing a really good job on the Pew family. Can I also have my... So it became a little bit of a multifamily office. And then I would say over time, again, we started getting interest from endowments, college endowments and foundations that said, well, could you manage our money as well? Then we started getting interest from some large scale institutional investors. So, today, Glenmede manages about $48 billion as of the last quarter. We manage it across individuals, families, endowments, foundations, and institutions. We do all the investment management. We also do, for the private wealth side of our business, the wealth management side of it, right? So wealth planning and wealth management comes into play. With endowments, foundations, we do the grant making. Our mission's pretty simple. We call it empowering financial futures. But what that means is, look, we're here with fiduciary duty to make sure that we're meeting the financial goals of our clients, but also the mission related goals, the values related goals. We have this mantra around organizations and individuals have kind of three categories and buckets they think of. It's their purpose, it's their passions, it's their legacy. That's the central kind of thread of anything that we do, any business line we develop. And frankly, from my perspective, sustainable and impact fits perfectly into every single one of those lines that I just said. Because for us, it's about helping us align our clients' investments with their values. It's about us helping organizations achieve their mission. It's about achieving their purpose. It's around leaving a legacy. And that everything we do is part of that. Look, the other thing that we do is we are seeking to grow the investment portfolios. There's no question, right? We're looking to outperform the markets and to grow those in a differentiated way. And our philosophy of sustainable and impact investing is that it helps us do that. It's that, again, companies with an impact tilt that are looking to solve problems related to the environment or society, they have a sustainable business advantage and they can outperform those that don't. And it's as simple as that. And, I'm happy to say that this group has grown tremendously. And you asked around, how much of the business represents. It's close to 20% of Glenmede's is directly invested into the sustainable and impact investing group's strategies and its remit. That number has continually grown. There's not been 1 year since I've joined. That number has not gotten larger.
What is the total AUM of Glenmede?
So Glenmede's about $48 billion.
And the sustainable and impact part is 20%.
That's a number very specifically that I am honing in on the investment strategies. We have a few categories in terms of how we split up the world on sustainable and impact. We have a category called mandated, which means that you're using positive or negative screens to, again, assess which companies are strong along impact dimensions or weak. That's broad. We have a category called thematic that's very specific. It's strategies looking at climate change or strategies looking at health. And then we have a category called high impact, which is more localized place-based investments. So that about 20%, of our AUM is invested just in those. We do have a fourth category, though. It's important to note that I'm not counting here, which is just ESG integration. It's just incorporation of financially material information directly in the investment process. The vast majority of Glenmede's assets are integrated because we just think it's good investing, frankly. I'm not sure it'll be a category in a few years. It's just part of what's good investing, frankly. But we did go through a whole process when I first joined around assessing what is an ESG integrated strategy versus what is not.
In terms of your client focus, is it US or are you global?
It's US only. We have clients in all 50 states. We do have, we have about 400 employees. About 300 of them are in our Philadelphia headquarters, but we do have 9 offices overall, essentially up and down the East Coast. And then we do have a Cleveland office as well. So certainly we're a national firm, but physical presence is really kind of East Coast, Midwest, US.
You describe yourselves as having a 4-to-1 client to employee ratio for white glove customization. So for a guy like me who's been raised in the Middle West of America and who's never seen white gloves in their life before, what does white glove customization actually mean?
Every single client experience is, I would say, an experience of one, truly. And that was another reason I came to Glenmede, in that we're not going to put you in a product. We're not going to put you in a model. We're going to meet with you and sit down and understand what you want to achieve in your life, in your community, with your family. And everything we do, from the wealth planning that we do, from the investment strategies, if you're sitting across from me, that I'm going to be proposing to you, they're very, very unique, and in often cases, actually hyper customized by us to achieve the values that you want. You're always going to be with a human. It's another way these days, right? That it's white glove. It's, if you want, it's in person, come to your house. We'll travel to you. We'll bring your team, and it's your team. It's not a lot of churn at Glenmede. It's the people that you met with at the beginning when you first met us are the people that are running your portfolio. And look, that what I've learned is that's very different than other firms. And we are really, really intentional around the number of clients we take on, because we want to staff them accordingly, frankly. And this is our biggest differentiator, that we can truly provide that customization. A lot of things in this world are a scale game and a commoditized game increasingly, but this human aspect is not.
I haven't had very many wealth managers on the show. What would you say is a standard ratio in the industry versus your 4-to-1?
I really don't know, to be honest. I don't know what the standard ratio is. What I do know is that the way that we think about client size and the way we service them is definitely different. So if you go to a very large wealth manager, their minimum investment size is usually similar to us. It's in the low single digit millions. We're mid, we're 5 million, but we service those clients in the way that some of these really large firms only service their largest, most important clients, if you know what I mean. Whereas a lot of the large firms, for those smaller, in their view, clients, they'll put them into a model portfolio, or there might be a hotline that someone can call. That's the difference, essentially. And what we like to say is you can have the experience of a $200 million family as a $10 million individual. And that's the main difference, I would say, just in terms of what you expect from us versus a large scale peer.
I want to drill down on the sustainable and impact investing side that you're specifically working on. What is Glenmede's mission and theory of change? What are the problems that you're focused on addressing, and the deeper change that you're trying to create in the world?
We're focusing on investing in companies that are solving environmental or social problems that are arising because of a transforming world. And that can mean climate change, we think, has enormous impacts on almost every sector of the world. We think shifting demographics, next generation. We think rising poverty in some parts of the world, food insecurity, issues with education are also creating, again, risks. And for us, we believe that finding companies that are seeking to solve those problems can give those companies a sustainable business advantage, while also achieving what we call sustainable prosperity. And this idea of sustainable prosperity is this idea of addressing folks at the bottom of the pyramid. And if you can find a way to lift up folks within the bottom of the pyramid, we believe that lifts all boats. That makes a society of more abundance and innovation, productivity. It doesn't create a net zero game, which is another view on how lifting up folks does. That means other folks have to be lifted down. It's not our view. So we always try to invest within that idea. Across asset classes, oftentimes we'll ask ourselves, like, okay, does this investment actually help us in some way achieve that prosperity idea? Is it lifting up some group? And do we think that will achieve an overall abundance and, again, a more productive and stronger economic output? That's the central thread of how we think. Again, with this basic concept, of course, always going back to, is this going to generate strong returns as well as impact, and are these two things linked? That's the thought.
You're doing this through what type of investments? Are you going multiple asset classes, or are you primarily focused in one?
Almost all asset classes. Our absolute holy grail is to be able to build out 100% diversified portfolios that take this philosophy that I said. It's very hard to do so, dependent on what the theme, the area of impact the client looks to achieve. If a client says, I just want to create good in the world and I'll take all of your best thinking across all themes, then yeah, we can get about there. The only area that we haven't totally cracked is hedge funds in terms of getting comfortable there. But when you think about equities and fixed income and private equity, venture capital, real assets, absolutely. Oftentimes, though, clients don't come and say, I just want to do good in the world overall. They say, I really care about the environment and I want your best thinking on climate. And climate's one where we can get about 60% 2/3 of the portfolio truly climate aligned in a way that we're excited about. Clients sometimes come, they say, I really care about education. That's one that's a lot harder to express in the public parts of the portfolio. So it really depends. We have a whole matrix that it's out there, but it essentially looks at by theme and by asset class and by sustainable approach, integrated, mandated, thematic, I talked about earlier. Where is there a robust opportunity set and where is it going to be a little bit harder? And that's our job, to be realistic and honest, frankly, with our clients when they come. And we've gotten this feedback that like, you guys are the only one that said that you couldn't do this, and it's a compliment. It's like, we can reasonably do this, upholding all of the values here that we want. With 1/3 of the portfolio, you're okay with that? And almost always the answer is yes. Like, they want real strategies. So it's pretty interesting. Look, the space is evolving, but that's how we think generally.
How would you describe Glenmede's sustainability and impact investing clients? And primarily, what do they want in terms of impact outcomes?
It's all over the map. We have clients of all shapes and sizes and all different segments. And what they want is very diversified. If I were to try to generalize it, the strongest pockets of consistent growth in our business and where the largest bulk of our clients sit are within multi-generational families with an onus more towards, I'm going to say next gen, but what I don't mean is like Gen Z or millennials. I mean Gen X, really folks that are starting to really get their hands on the wheel of those large multi-generational trusts in some cases and want to make an impact in some way. The other segment is foundations, US private foundations that mission is at their core, and investing a large chunk, if not all of their chunk in their capital in mission related investments is key. Those are the two segments. Doesn't mean that the other segments don't want this. We've seen this success across all, but those are the two ones that I would say make up it. Now, thematically, I would say climate, if I were to pick one, is the one that is the most pervasive. And I think it's a view of that we hold as well, that climate intersects with almost every other theme. Climate impacts health, climate impacts racial gender equity, climate impacts financial inclusion and economic empowerment. So there's a lot of relationship. Climate's also very investable. That one's the number one. There's other pockets, right? And again, every client is a universal one. So oftentimes we'll have a client come and say, I'm really interested in racial equity in Ohio. Okay. Right. And our job is to go figure out a way to achieve that in a way that's intellectually honest to them, frankly, and say, here's how much we can do. And here's how much you say you don't want to conceive returns. Here's how much, whatever theme or area you're talking about, that we wouldn't be comfortable going beyond unless you tell us that you're willing to give up a little bit because the space just isn't built out yet. Right.
I imagine managing impact priorities across multiple generations within the same family can get incredibly complex. How do you navigate situations where you've got grandparents and parents and adult children who have completely different views on what impact matters most?
It's fascinating. I feel like my job sometimes like a family mediator, right? Or a family therapist. Some of these meetings I'm in, oftentimes you'll have 3 generations of family in the room. And I guide these sessions through in a way that is truly just asking questions for sometimes 1 to 2 hours. Tell me about purpose and passion and legacy of the family as a whole. Tell us about what's important to you. I'm not trying to lead the witness at all. Tell me what you think about climate change. No, I want to hear from them some of the things that are most important to them. Frankly, what I try to do is I try to draw out some of the central ideas that I'm hearing from those conversations that I can hone in on and say reasonably after a couple hours, like I've heard from, 20 people in the room. And am I right to say that it sounds like this idea of financial inclusion or lifting up people that don't have the means that you did is a central, important thread that has guided your grant making and some of your work over the years. That's one example of kind of a high level idea of lifting people up with less than you. Yeah. Sometimes I get agreement on that. And then it's my job to go out and find proxies for that. Maybe that could be an affordable housing investment. Maybe it could be a health access investment. Again, other times I'll hear, it sounds like nature and protecting the environment's been a central thread for all of you in different ways and different things. Is that fair? Yeah. And then it's my job to go out and find investments that can come out versus saying, what do you guys think about ESG? Or how about climate change? These are sometimes politicized words or angles that can, create a rise out of someone. And it's a much better approach to really learn around. It's like going back to first principles with how people think. And it's people don't think as I want to do ESG. They think it's really important. Like you asked me at the beginning, it's really important for me to find ways to give back to the world. And then toss things out of that, right? Oh, tell me about, oh, your mom was an educator. Is education important to you? It's that. Doesn't mean it's easy. Doesn't mean the conversations are as smooth and wonderful as I just articulated, but we get there in the end typically. And we end up getting at the heart of a lot of perceptions in this space too, around how some people think about it.
Can you share an example of how you had a multi-generational family, especially divergent views, and you finally pulled them together around a common impact strategy?
Actually one that was 3-generation family that the younger generation invited me to come and present. And specifically, they were intent on climate change as an investment strategy. And actually, they were intent on divestment. We don't want any of these oil and gas companies. We don't want any fossil fuels, right? Evil for the world, right? And I said, are you comfortable with me kind of presenting from a few different dimensions of the environment? Because what I did then was I also asked them, are you comfortable with me meeting with each generation before I come into the wide forum? And they said yes. So the older generation was absolutely against anything with the word impact in it, anything with ESG, and any semblance of divestment, just full stop. And they viewed the entire space as concessionary. They viewed it as political in nature, not investment focused. And they viewed divestment as a fool's errand in their view, that anytime you reduce your investment universe, you're reducing your potential return. The middle generation said, we don't care about climate at all. We care about gender equity. So that kind of threw a wrench into it. So what I did was this. What I presented was this idea of how could we seek to integrate a multi-phased approach to implementing some of the values that I've heard in this from the 3 generations. I heard returns above anything else from one generation. I heard gender equity from another, and I heard climate change at all costs from a third. And I said, what if we took an approach where the first phase of our approach is almost a testing period? It's a pilot. We take 10% of the portfolio, and we're going to start with integration as a big part of that portfolio, just making sure we're integrating financial material risks. We're not limiting our investment universe. And we're going to take some of that percentage, and we're going to invest in some strategies that are focused on climate, but from a positive perspective, from an active ownership perspective, that aren't going to divest, let's say, right away, but they're going to try to work with those companies to produce change. And here are the goals we're going to track as part of this. And on gender equity, let's make sure that we are investing as part of that into managers that have a strong female leadership and inclusivity component as part of them as a first step. It's not the end step. And that was the only thing I was trying to get buy-in. I said, we're going to come back in 1 year and we're going to see how we all feel about this. And that was ultimately where we landed in that first stage, which, again, it satisfied everyone, but didn't thrill anyone, but it satisfied everyone. And it's okay to sometimes go for that, to be able to be a gateway to now, 6 years later, where 70% of their portfolio is in climate-focused strategies. About 80% of their portfolio has gender equity incorporated either from an intersectionality standpoint or from an ownership and inclusivity standpoint. The returns, I should note, have absolutely met all their financial goals. We have not seen a conceding from this. And believe me, we're constantly showing them, here's what you would have done if you just kept your old portfolio. Here's your new one. It was all around building trust and understanding and being willing to do a test period and to satisfy everyone, but not be okay with not thrilling any one generation. Because if I had presented something that only appealed to one generation, we would have done nothing from my view. So there's a pragmatic approach, I think, to this too.
Are you seeing different expectations and demands, particularly from younger generation clients?
Younger generations, on average, tend to be more interested in impact. They really interestingly tend to be more interested in localized place-based impact, really interested in like, what can I do in my backyard that's really tangible and really exciting? That's really interesting to me. There's the other side of it where I think the younger generation also, they have a lot more skepticism on the actual impact components of it. Meaning, like, when I talk about, look, active ownership instead of just divesting from all of this, there's a lot of correct skepticism on like, how are you actually going to hold these companies accountable for this? You know, you're saying that the company is going to be, let's say they're doing a net zero 2050 goal, right? It's like, how are you going to track this company? You come back in a year and how are they actually going to do something? So I think that's good, really healthy skepticism. I think the final thing I would say is they leverage technology and they want aspects of do it yourself much more on average, where we've rolled out tools that actually put all of our impact measurement in the hands of the client. And I'll just tell you that very few of our older generation clients actually go into the links and click through and are looking at all the different exposures of all their companies and the impact metrics. Almost 100% of the next generation is doing it on their phone and coming back to me and being like, hey, I saw I hold this investment in XYZ pharmaceutical company, and I saw they did this and this lawsuit. Like, tell me about that. Again, that's a net positive. We have the answers, but that's a big difference where the way that they want to be presented to is also very different. Pretty fascinating.
I'd like you to walk me through Glenmede's client engagement process, starting from the point that you call values discovery, which is what we've been talking around, all the way to the portfolio implementation. I'm interested in how you go about translating someone's abstract impact goals into measurable strategies and investment portfolio allocations. And what does that conversation look like?
I'll use that same example of that same family, but how we actually translated it. So we try to put process around things. And again, every client's one, but we try to think, what are the consistent steps? So us and actually all of our relationship managers that are out in the field all day long are kind of trained on this process. So we don't, step in something by saying, hey, what about this ESG thing? Again, it's the exact opposite of what I want us to be doing. So it's 5 steps. It's inquire, it's educate, it's assessing, it's implementing, and then it's measuring. Those are the 5 steps. Everything we do is those 5 steps. And let's talk about that client we talked about. A lot of it was inquiring first, me just asking a lot of questions, which we talked about. A lot of questions. Tell me about what's impactful to you. Okay, so you're saying the environment. Okay, well, tell me why you're interested in that. Tell me what you've done historically. Tell me why you haven't invested in this way in the past. What you mean by environment? Do you mean conservation? Do you mean water? Do you mean food and ag? Do you mean, I'm really worried about climate change, I want to invest around it? So getting at the heart of what's important to them, why it's important to them, why they haven't invested. And oftentimes perceptions will come out, well, I didn't want to exclude a bunch of stuff, or I think it might be bad for returns, right? Or I just don't know enough about it. So then you get into educate. And that's where it'll be my team. I have a 5-person dedicated team. That's all we do is what we're talking about today. All we do all day long is find the best sustainable investment strategies out there. We write and speak about them, find new research areas, and then we go meet with clients. That's all we do. But then I also sometimes bring in other specialists, other thought leaders in the field, others to really be able to educate them on very specific topics. And even within my team, one of the people on my team is a climate change investment specialist. It's all she does all day long. So oftentimes we'll bring her in, right? Technical aspect of this. But it's education. It's here's divest versus invest. Here's examples of active ownership. Here's data on performance of climate-related investments, let's say. Here's some illustrative examples of how to do this. Here's how we would measure it. It's all the education standpoint. Again, I learn a lot more from those conversations around what they're open to. And that's where with this family, learned that they actually were very open to this idea of investing, not necessarily divesting, being open to hold some traditional energy conglomerates that are shifting. That was where I learned that. And then it's assessing. And assessing is actually looking at a lot of the traditional aspects. You asked about wealth management and how it differs. So we manage a lot of trusts and even irrevocable trusts. And irrevocable trust, for the listener, right? Fancy way of saying this trust will never be able to be closed or ended. And this trust will be in place in perpetuity, not just for the parents and their children, but for future generations that have not been born. So a lot of the assessment then is even thinking from a fiduciary duty perspective on our end of understanding what sort of account is this? What's written in these documents? Irrevocable trusts are underpinned by a document. It's very hard to change, as you can imagine, that says, here's the purpose of the trust. And we have to make sure that what we're recommending, especially if we're recommending something that's going to really narrow the investment universe, or it's going to be really specific to one theme, let's say, we need to make sure that this actually fits what is laid out in the trust. Because you put yourself in a courtroom 100 years from now with a future generation that has not been born, and they could be saying, I didn't ask for this crazy impact stuff. What is this, right? And we could get sued actually 100 years in the future. It's an assessment by us and the family on saying like, okay, well, you set up the trust to do X, Y, Z. And oftentimes the trust language is very broad. It's like for the benefit of us, but our communities around us. And that's okay, well, we can do this. But there is a lot of technical assessment I find very fascinating around this idea that we have to make sure that we're on the right side of, right? From a fiduciary duty perspective. But what helps us at the end of the day is that every investment that we do in the sustainable impact group, We assess it in the exact same way as a traditional strategy. It's the same investment committee. We're stacking it up on performance against traditional strategies. We're making the investment because we think it can outperform the market and a peer group. So that is really important because that, rightfully could protect us from this. Well, it impacts stuff. It's like, well, Glenmede did the work and these were strategies that were just as good, but we do a lot of work on portfolio diversification as a whole. If we had a client come to us in one of these trusts that cannot ever be changed, and it says that you have to make sure that you're doing market rate or better returns, and a client said, I want 100% of my portfolio to be education focused, that's going to be a pretty narrow investment universe. And that is one that might not perform in line with a broad benchmark. And that's where we come in and we say, we're not sure that totally fits with the trust. What if we did 20% of it, 10% of it? So that's the assessment period, which I wanted to cover because you asked about wealth management. It's something that's really specific to the wealth management world and the trust world that I think a lot of folks don't know. So that's assessment.
You've said that when people first say they want to invest sustainably, they're often lying to themselves about what they actually care about. What do you mean by that?
I think it's about one, having never gone through the process of thinking about what that could mean even more specifically. It's like, yeah, the environment's really important to me. And I think it's translating a personal value into what are the most important aspects of it that really concern you or you're really passionate about that you want to be reflected in your investment portfolio, And look, the answer might be, and this is fine. There's no answer that's wrong or a lie. It's the environment as a whole. I'm open to any investment that you think helps the environment. Okay, great. We're going to do that in a whole different way. But I think what comes out of those conversations often, and where the family part comes in, is people find common alignment around one aspect. It's like, actually, it's conservation is the most important part. Or actually, it's just our natural world around us in our local community. Or actually, it's really the health effects of a bad environment. We actually really care about the health side of it. That's what comes out. That's where it gets really interesting, where it helps us as investors then be able to truly express it in a pronounced way versus saying, oh, the environment, here's our environment fund. Thank you. Right? It's like, no, there's a lot of layers down from that are important to express. So it's more just getting, again, yeah, they're investment conversations, but they're also like family mediation. It's like trying to get at the heart of these really specific things that guide people. It's not an easy question, right?
Before you implement a strategy after you've gone through all this discovery process, I'm sure you must try to ensure that this strategy truly reflects what the client wants to achieve with their impact. When you're going through this process to try to make sure you got everything aligned there, have there been moments when the process reveals a surprising misalignment in the end?
Yeah, there are moments. And even on this same example, what we try to do coming out of the assess and right before implement is we'll come up with what we call our impact investment policy statement. So investment policy statement, everybody lays out types of investments, their financial goals. The impact side, we try to make really specific with the same rigor that one makes an investment policy statement. So we try to get really specific to your question. It's like, interested in climate across as much as the portfolio as possible, seeking at least 25% alignment by X date, seeking specifically to reduce this client we landed on, I remember initially, reduce carbon emissions by 50% over 3 years, reduce freshwater withdrawal intensity by 50% in 3 years, which is basically how much water is needed to support the companies in your investment portfolio, have at least 50% of the portfolio invested in women-owned or women-managed strategies. And fourth, it was have at least 2/3 of the portfolio have impact alignment in some way. So we had these 4 goals that we laid out. And we did a lot of testing around it. And what we do to test, just so you know, is we'll put together a potential sample portfolio of all of our best thinking across different strategies that we think will achieve these. And we test it we run it through, we have this platform, it's called Your Stake. And what you can do with Your Stake, think of it as like a visualization software system where you can feed in different data sets. So we feed in a few different data sets, from ESG data to impact data. There's a bunch of nonprofit data that goes in there. And basically it provides a look through of any portfolio. It looks at all of the underlying holdings. It has like 200 different metrics you can look at. And what we found was this portfolio that we put together, the carbon emissions profile barely moved, actually. The water side looked really strong, potentially. The gender side looked really strong. The impact alignment broadly looked strong, but carbon emissions looked actually poor. And in some parts of the portfolio actually went up. So we kind of went back and we thought, well, we're doing something wrong, or do we need to have another conversation with the client around what are the right goals? And it was a conversation, as you can imagine, of invest over divest. Like, are we really willing to invest in some bad actors, some very carbon intensive businesses today that we believe are shifting, or we can help affect change through shareholder engagement, through shifting? And if we do, and if we're comfortable, how do we measure that? So that's where we ended up totally changing that goal. And we instead had a goal around carbon emissions momentum, which basically looked like over a 12-month period, how do we see carbon emissions shifting within our underlying portfolio versus this end goal of just, we're going to get to zero, if that makes sense, which enabled us to kind of have a churn year over year of saying, okay, we've now shifted these companies towards a stronger approach. We need to go out now and find others to seek to shift. But that was a big decision. The client could have easily said, no, we want to stick with the carbon emissions, and we would have used different strategies then. They would have been, frankly, probably more divestment driven. We would have different selections. So that was one. This happens a lot, where what is revealed by that impact measurement part of it says like, well, this isn't even close to hitting what we need to. And let's talk to the client and see if they're comfortable. Because again, at the end of the day, we're not going to invest in a lot of strategies that we also think are going to be adverse from a returns perspective. So it's this balance that we're trying to achieve there.
Let's get into that part about what your clients actually want in terms of impact reporting. And are there any particular metrics or KPIs that seem to resonate most with people when they're trying to understand whether the money's creating the change they want to see?
They want raw data. They want tangible, raw dollar figures of what their capital is creating. And also they want to be able to relate that to something that is understandable. And, a good example is a carbon emissions reduction target is one that really resonates. A water reduction target is one that resonates. Another one that resonates is what I would call temperature alignment. Everyone sees the 1.5 degree Celsius level as this really important marker. It's well understood. We know that as you go above that, there's an exponential worsening of effects on the world. So a metric that we do provide in many cases is that here's what your portfolio, what temperature kind of scenario that's aligned with. It's a mix of their emissions and their commitments. That's one that really resonates. And even in some cases, we ask, it depends on the client, right? But some of them ask us to translate it. Like, you have all these metric cubic tons of water. What is that? How many gallons of water is that? So we do have that translatability there. Some clients want it, some don't. It really depends on the audience. I'll tell you what nobody wants is us to come and say, your ESG score is a 7 compared to your benchmark of a 6. You're doing a great job. Nobody wants that. And I think that the world is really shifting away from not using them for anything, ESG ratings and ESG scores, but treating them as the end all, as like, yeah, I'm going to pick a company that's strong in this rating, and then I'm going to report on it. No. And I think the world has correctly found that to be not only not tangible, but also not a great way to create impact. We're spending a lot of time on your exact question, which is theme by theme, going through and trying to understand what are the 4 or 5 metrics that we believe in, that the clients believe in, that are tangible, that we think we can achieve, and really going away from overuse of ratings and scores. I would say they're not useful.
Glenmede has a proprietary 4-category taxonomy. You've mentioned integrated, mandated, thematic, and high impact concessionary. Can you walk through those 4 categories in a little more detail and explain how, or if this actually clears up the confusion between things like negative screening and true impact, and how it helps avoid greenwashing?
I think it helps. We start a lot of conversations with it because a lot of times clients come to this and they're like, yeah, I've heard about this ESG thing, or sustainable, or impact, or SRI, or responsible. What's the difference? What's it all mean? Right? It's like, yeah, there's all these terms out there. But again, at the heart, we talk about our philosophy, and then we think there's 4 different ways to do it. And frankly, when I think about a lot of the headlines and all of the rhetoric that's been out there the last few years, ESG works, or ESG doesn't work, or ESG is not creating impact, or, correct. All of those things can be true, and none of them can be true, because ESG is not an investment approach. It's a set of data, and it's about what you do with it to produce impact or to just help you be a better investor. So I've always been confused by this idea of ESG as an approach or ESG as an investing term. It's a set of data. And we thought it was really important to establish these four different, we published on it. We were out there really strong on it a few years ago around like, we think there are four different approaches because ESG integration is not about creating impact whatsoever. There's no impact as part of that. It is strictly incorporating financially material information as part of your approach. And you could still choose to invest in a company that actually you see some financial material risks, but you think, you know what, this stock is cheap and I'm only going to be holding it for 6 months. And I don't think any of these risks I just saw on the environmental, social, governance side are really going to impact the name. I'm going to invest in it anyway. I'm going to monitor those risks. I've looked at the work. There's no impact whatsoever on integrated. And I think that's really important because a lot of strategies came out calling themselves ESG, which frankly were just integrated. And then, of course, you have disillusioned clients then look at this and they're like, I thought I was in an ESG fund. What are all these companies? Where's the impact side? And it's like, that's not the intention. So that a lot of the headlines were because of, a misnaming or an overgeneralization around what this space was, frankly. So that's integration. Mandate now, we do start to shift to this idea where you are starting to limit your investment universe in some way. You do have your finger on the scale, I would say, with looking to prioritize companies that are strong along environmental or social dimensions and looking to negatively screen out companies that aren't. But it's broad. It's, again, looking at a number of different factors. It's an inherent belief that companies that are stronger along these dimensions will outperform those that aren't. It's also a category that does encompass those clients that come faith-based often that say, I just don't want to hold XYZ sectors. It fits there. And I would say mandated is the area that I see as really exploding kind of in the 2016 to 2022 period and really kind of dwindling and going away in favor of thematic, which is where we're spending a lot of time, where we're seeing a lot of interest. And I think is really exciting for the space. Thematic is your finger's definitely on the scale. You're honing in on one environmental theme or one social theme, and you're investing around it. Maybe the theme is climate change, or maybe it's even more specific. Maybe it's circular economy, right? Or maybe it's food and agriculture. And you're looking at companies that are looking to make a pronounced impact on that problem, looking to solve that and developing businesses, again, that can be sustainable around that and will outperform because of that. But it is a more narrow investment strategy, of course. And that type of idea, which kind of gets back to the first principles of why a lot of people like me got into the space, has been really taking off. It's been long the way that private investments have been done. Back to the flat world days, that's what we were seeing a lot of. But now we're seeing a lot of public strategies come out that are looking to focus on these themes, a lot of active ownership. That's a really interesting one and a really exciting one. And then the fourth one's very different than the first three. First three I said are all market rate seeking. Mandated and thematic are trying to achieve an impact, but it's right alongside only if it can result in higher returns. The last one, aptly named high impact concessionary, that's an approach that is impact first. It's actually saying that our number one priority is impact, and we are willing to concede returns to do it. And this is structural by the nature of the instruments we're investing in there. So another term listeners will be familiar with maybe is program-related investments. It's a lot of foundations, nonprofit make these. They can count towards your 5% annual required distribution as a note. But these are investments that are typically loans. They're loans to small businesses on a local level with a goal to make a pronounced amount of impact. And again, it's at the detriment of returns. And I'll give one example. One of the investments that some of our clients participated in was in early COVID years. It was in the Philadelphia area. It was loans into daycare centers that were located in spots with a high propensity of people below the poverty line. And you can imagine during the beginning of COVID days, a lot of fields like us, we could have the luxury of sitting and turning on a Zoom and still doing our job. A lot of the people in those areas were service level workers. They had to go into work and they needed daycare for their kids. These daycares could not get stimulus in time. They couldn't get capital to keep the lights on. And these loans, 12-month loans to daycare centers in these areas at a 2% interest rate. It's concessionary because a bank loan would probably be 8 or 9%. This is 2%, the same level of risk. You fast forward a year, all the 2% was paid back. The daycares kept the lights on. They had a very clear impact metric. Here's the number of kids below the poverty line that were serviced. High impact concessionary, it can be really tangible, really impactful, really exciting, but you are conceding returns. So it's a small part of portfolios. But I just want to call that out that, again, I referenced that generationally too, we are seeing some more interest in this idea, which I think is pretty interesting.
What percentage of your AUM that's in sustainability and impact is in that concessionary?
About 2%, 1% to 2%. And most of the allocation is by nonprofits and foundations. that are using that.
About 2 years ago, you launched the Sustainable Investing Advisory Council with some impressive external experts. What's this council designed to accomplish? Maybe you can share an example of how this external input has changed how you do things in your shop.
For us, it's to help us look around the corner in what is a really dynamic and evolving space. And it's a sense check for us in some ways. It's a way that we can brainstorm and get ideas on where we might be developing a new strategy or a new thought process. And we're leveraging the brain power and the reach and even the geographic location of this group. Something that, is a good example here is Tunsi Whalen is one of the members on the advisory council, and she's the head of the Sustainable Business Center at NYU Stern, and certainly a well-known academic in this space. And, something that she really helped us with a couple of years ago was honing in on this idea of what is a quality job. It was this idea that was coming out of COVID. It's very relevant again now, I will say, around what makes a quality job and what helps from a retention standpoint, and what can we actually link to returns. It was kind of trying to take the S in ESG from an abstract idea into one that's tangible and investable. And what she and her group did along with us then out of those conversations at the council was we looked at a number of different proxies for quality jobs. And it was, did the company have dependent care offer? Does it have strong work-life balance? Does it have strong diversity in a number of different ways at the organization? What does that look like? How do you measure it? Healthcare benefits, all of that, and tied them very specifically to companies along this proprietary framework we developed on quality jobs actually had a much stronger return on equity than the ones that don't, because of course they're keeping employees that they want to keep. And look, we're doing a lot of research right now on that, because now in the US, we're thinking about it from what is reshoring of quality jobs in the US look like if we buy that certain parts of the spectrum we reshore in the US. So that's an example. That's academic research. We've spent a lot of time with Mark Campanelli, who's also on the council, very well known. He's based in London, climate thought leader. He's really helped us better understand how this policy landscape is shifting, how it could shift going forward, how as the US pulls back in some areas, how Europe and Asia could benefit, and who could be the winners and losers here. So it's us testing ideas. It's us hearing from them on their best practices. And frankly, sometimes it's them joining client meetings. I actually had Mark Campanelli join that client example I gave earlier as a thought leader to help educate and talk about his perspective on climate transition, which was super helpful, right? So look, our clients can benefit too from them. So it's been great.
I'd like to shift gears now and talk about something that you recently did, which was a comprehensive analysis reviewing roughly 70 public equity impact funds. That's, a significant undertaking. I'd like to know what the key headline findings that came out of that maybe everyday retail investors should know before allocating to this space. But I guess there's another question that I get asked all the time is, how can you really achieve impact with public equity shares that are all being traded on a secondary market? I really want to know what the outcome of this report is, because there's a lot of people listening to this who aren't qualified investors and often want to know where they can invest and have impact with the funds that they have.
First, on the analysis. So we did it twice, and it's important when we did it. So we looked at about 70 strategies that were stating that they were integrating ESG, or ESG was a central part of their investment process. And we did this first in 2020, towards the end of the year. And then we did it again at the end of last year. And in the end of 2020, of the 70 that said that they were, we found about 20 that in our view actually were doing so in a way that could be additive to return generation, because of the way that they thought about having their own proprietary data sources versus just picking a rating off the rack, the way they were excluding out large parts of the portfolio or positively tilting, the way that they had expertise in-house on people that really understand impact, and the way that they were providing reporting. So about 20 of them we found in our view, again, our view alone, but our view based on this long, set of questions, right, that I talked about earlier. We did it again the end of last year. And what's interesting is that we asked the same 70 that had said before that they were. And only about 30 actually now are saying that they are. And what we found is that Some of the ones that are saying that they are not doing it actually are now, if that makes sense. Meaning, we actually found a group of about 45 out of that 70 that actually are doing a lot of these things that I talked about. They're just not talking about it. And I would describe this as a move from greenwashing in 2020 to green hushing now, where actually some strategies are doing this, but they're not comfortable because of the politicization or because of the regulatory framework to actually say they're doing it. So as a retail investor, then how can you actually sort through this, right? Because now we've gone from, well, a lot of them are saying that I am, but I'm not. And now it's the opposite. Well, how do I say it's good? Look, certainly you could work with a firm like us. Let's put that aside. There are tools out there that are available for anyone that also can be a helpful guide for anyone listening to see what they own. I'd really recommend checking out an organization called As You Sow.
As You Sow, right. Andrew Behar.
Andrew Behar, yes.
Yeah, he's been on the show before.
And he's terrific. So they do a whole lot of things, and they're known for shareholder engagement and active ownership, which is super important. And we partner with them on that as well, I'll note. But they also run a really interesting set of web pages that you can look. If you just look at it As You Sow, and you'll see different web pages. They have a tool where you can type in any mutual fund or ETF ticker, and it will give you their raw exposure into a whole bunch of areas that are related to this world. Any theme that we've talked about today, a whole bunch of different areas in terms of their exposure. It'll give you a good snapshot on their approach, divestment, active ownership. And based on theme, you can look, okay, gender equity, you can look on climate. As You Sow assigns a rating, A, B, C, D, F, based on what their actual portfolio looks like compared to what they say they're doing. And that's a really nice guide for anyone just to kind of sense check, like, oh, okay, within my IRA, let me type in some of these funds that are telling me they're doing XYZ. Let me just see what they actually hold. Let me see some of the exposures. And that's just a good tool that, I think retail investors should leverage.
Tools are only as good as what they're built on. Have you ever looked under the hood to understand what's that based on?
It's based on raw data. So that's why I like it. It's not based on MSCI scores or a third-party rating. It's based on As You Sow, simply mapping the exposure of, let's say they're looking at climate. They're looking at, and you can look, they have the methodology there. They're looking at emissions. They're also looking at the percentage of what they call green revenues that are actually in the portfolio. So if you're investing in a positively tilting climate strategy, ideally you want to have exposure to companies that are investing in alternative energy, into green real estate, into food and ag. Those are examples of green revenue. They're actually looking at the percentage of green revenue underpinning the portfolio in that climate related strategy. Same thing on gender equity. They're actually looking at the percentage of women on the boards and on the leadership teams of those companies. And they're just giving you the number, and they're assigning a score to it based on where it sits of the spectrum of a peer group. So again, that's exactly the type of approach I value, because it's in, the beauty is in the eye of the user, right? You want to put some of the power into the end client by looking at it and saying, okay, well, I'm in this climate strategy. Only 5% of its portfolio, right, is associated with green revenues. That seems low. Let me understand a little bit about why that number is so low. Okay, let me look at their shareholder engagements over the last year. Let me see some of their activity that they're doing in practice. And then we'll show you a peer group, and you'll say, turns out this climate strategy I own is in the bottom 20% of all climate strategies in terms of a couple of these key raw metrics. So I think that's the right starting point. Look, it's not the end all. At the end of the day, you can go then the strategy, you can read their commentary, you can read a lot of the materials, again, that are publicly posted. Obviously, you can work with a financial advisor too, but even if you don't, that gets you some of the way there to kind of sort through what's potentially real and what's definitely not, if that makes sense.
Let me back up and go back to your study, though. When you described it, I think you said you were evaluating them based on ESG, but did you do anything on impact, or is it ESG? Because you've differentiated between ESG is not impact. Did you look at impact or no?
It was both, depends on the category. So this study was a mix of ESG integrated, which there's no impact as part of that. That was just, are they using ESG to value add? But it also included the mandated and thematic strategies as well, which those, yes, part of the assessment is impact. And really important, when we assess a strategy, we assess it on things like, do they have proprietary data or not? Do they have a strong team? Do they have a strong engagement approach? And do they produce impact that we can see and that we can measure? But really importantly, the weighting we put on impact, for example, is 0% when we're looking at an integrated manager because we don't care. We don't think that's their intention. The weighting we put on impact for a mandated is a little bit higher, and the weighting we put for a thematic is a lot higher. So my way of saying this is whether we deem it ESG isn't really the right to say it correctly, as you said. It's whether we deemed it integrated or not, whether we deemed it mandated or not, whether we deemed it thematic or not, because each one of them, we're looking for slightly different things. And there's a higher bar, frankly, for a thematic strategy to show us measurable, tangible impact that they're reporting on as compared to an integrated where, frankly, we don't, if they have it, that's nice to have, but that's not an integrated strategy's intention, if that makes sense. I'll give you a couple of general findings. A couple of the biggest areas we saw folks falling down on in this were they had impact measurement, but there was no consistent intentionality as they made the investments around those impact goals, if that made sense. It was just they were kind of capturing results as a byproduct after the fact versus what we want to see is as part of the process, if you're investing in XYZ company, you're looking at all the fundamentals and you're looking at, does this fit our very clear goal to, let's say, again, reduce freshwater withdrawal, to name one, or not? And that's what we want to look for, because then the reporting is just a capturing of that process. We found way too many that are just kind of investing as they usually do. And then they happen to run a report that characterizes things. And the problem with that type of approach is that's what we saw a lot of times in 2021, 2022, where a lot of just tech funds would just score well on some of these ESG metrics. And you'd say, well, look at this great diversity we have. And look at this, and it was just because there was a tech fund and the tech funds happened to be strong on that versus looking across companies and saying, we're only going to invest in the ones that are strong and then reporting on it. That makes sense. And that was worthy skepticism about these funds, as people were saying they were perform so well. And people would say, aren't these just tech funds? A lot of them were. That's why we try to build that in. That was one of the things we saw a lot of folks fall down on. We did this analysis.
What percent of the 70 actually disclosed outcome level impact? And out of those, how many or what percent actually were delivering impact that you view credible?
Less than half disclosed them, and less than half of those we thought were credible. And what I would say is that it depends on the category. Thematic, I'm finding really strong work being done. And those that we analyzed looked pretty consistently strong around being able to build in impact into their approaches. Because look, I think to survive as a thematic strategy, you have to have that credibly. I think the mandated side is where we saw a little bit less on average that being delivered, because a lot of those mandated strategies, again, are just taking a score, they're building it into their portfolio, and they're using positive or negative screens. And how do you really capture the impact of that? That's a harder question. And I think that's one of the reasons why mandated strategies are decreasing in interest, frankly, and a lot of the market's moving to thematic, I think correctly. It's a lot of the work we're doing.
Can you take me through a couple of examples of what a credible impact fund looks like versus one that's just impact washing, maybe?
There's a climate focused strategy that is on our platform that invests globally, and they invest specifically around climate. And they have a very pronounced mission that underpins each one of the investments they make. Meaning, one of their verticals is new energy. So as new energy, very specific, we want to be lowering the emissions overall of the global output from an energy production standpoint, right there under energy. Then they have a food and ag category, and they have two goals. They have one in water, which I talked about, but they have a second one, which is we want to make sure that we're increasing efficiency for every meter of arable land. We want to show that our investments, which are a lot of agricultural technology investments, as you can imagine, are increasing that efficiency. So they're looking to see year over year per meter that their companies cover, what is the yield? Very specific. It's a very specific metric. And those are just two of their verticals. They have a few others. That's a good example on they have a very intentional approach. In both of those sectors, they have a very pronounced investment view on why those are going to be good investment sectors. But then they also have a very specific view on how are they going to track that and what does success look like. And look, they share case studies with us where they'll say, we looked at XYZ public company and really strong investment case. We couldn't find that they were tracking this efficiency number on the efficiency of crop yield or arable land, or how the water irrigation is being treated. And that, again, gets back to the very beginning of this conversation, where for them, they're like, unless the company can answer that, we think the company is less viable at building a sustainable business advantage versus its peers. That's how it comes together, if that makes sense, where we're asking for those individual case studies. And look, part of our approach is we'll pick out random names in the portfolio. We'll ask the manager, like, tell us about this one. What's the thesis here? Like, wouldn't expect XYZ company to be in this portfolio. And some managers fall down there, right? They're only doing it on a part of their portfolio. So that's a good example of one along the climate theme on exactly what we're looking for and how we make sure it's linked into their thinking and it makes them better investors.
I know right now I'm going to get 1,000 messages, people saying, is this report published anywhere? Have you made any of the results of this study public at all?
No, we haven't really.
Because people are going to want to know, what's the name of the funds?
A good way to think about a way to see our research is we do publish a fair bit. We do webcasts. We have what we call our Outlook every year that we put out. That is a really good read, and it does encapsulate a lot of what we're saying. We won't give the exact numbers that we're talking about here, but it encapsulates a lot of what we're finding, and it helps frame where we think the market's going and where we're going to focus our time. And it also helps us, again, develop a better way to evaluate managers going forward. That's, one way to get a sense of it.
It doesn't have any fun names, these reports that you're referring to.
It doesn't have any fun names. And I think I'm generally not supposed to talk about fun names in these public conversations. But again, what I would encourage folks, other than talking to us or your advisor, is that As You Sow tool, I do think will lead you to some of these names in terms of generally as a retail audience. That's a way to get a really good sense. Their framework's not totally different than what I'm describing.
Well, of course, I'll put the link in the show notes, and actually a link to my episode with Andrew. That was really interesting, and a great story about putting a tracker in a Starbucks cup. If you don't know the story,
yeah.
About the recycling and program and all that. Getting back to another part of my question, that was part of the question that I don't think we got to, about whether or not public equities can really have impact. Tell me about your approach to active ownership, and maybe you can share an example of where your engagement with a company led to meaningful change.
Active ownership, I think, is one of the most important tools that audiences have, including retail investors, to affect change through capital. And it can take the form of just voting your proxy, but more often it can take the form of really helping to spur shareholder resolutions and then coalescing around them. And we partner with As You Sow, who I mentioned already, on shareholder resolutions. We do so through some of our own proprietary strategies, but also many of our investment managers leverage them as well. A really good example on how this can affect change. This is public, so I can, in this case, say the name of the company. This is a company, Citigroup, financial services firm, that had a shareholder resolution that As You Sow drafted. As You Sow basically does a ton of research, and they have a few issue areas every year. And then they say, they heard from Andrew Behar. It sounds like folks who listened to that episode. But Citigroup, really interestingly, the shareholder resolution asked them to disclose gender parity figures for the first time. So gender parity, this idea of for every dollar that a man earns at Citigroup, how much does a female counterpart earn on average? And the shareholder resolution ended up having a lot of clients. Many of ours also coalesce around this resolution and ended up passing. So Citigroup had to disclose the number. So Citigroup disclosed the number, this is a few years ago now, and it was 62 cents. So 62 cents for every dollar the man owns. So of course that's a bad number. And you can see why it's not something you want to necessarily disclose. What was so good about disclosing it is that they immediately, of course, then put a whole process in place and said, look, we recognize this is a problem, and we're going to try to fix this. We're going to have a gender pay policy. We're going to have ongoing reviews, make sure that this is happening. And they actually just disclosed their most recent one, and it's something like 97 cents on the dollar, right? It's basically parity. If you're focused on gender equity from an impact perspective, if you believe that, and certainly we do, and all the research supports this, that a more diverse set of leadership and staff is going to outperform one that's not, then that's important too from a returns perspective. And that's an example of an engagement that really made a big difference, right? That drastically shifted that specific very large company. And frankly, it's not just them. A lot of other companies that didn't get shareholder resolutions, you suddenly saw also announcing programs around gender pay parity. So that's this idea of scaling impact. If you do this for one company, others will follow around it. There's lots of examples, but I think that's a really powerful one.
Do you have a escalation framework that goes from engage to collaborate to file? What's your typical timeline for moving through these different stages, and how patient are you with companies that are slow to change?
1 to 2 years on average. It can be shorter or longer, but very seldom is it less than 1 year, because we want to give adequate time to actually observe and to let this work its way through sometimes bureaucracy, or also to be able to see the effect of it in practice, frankly. Longer than 2 years, more rare, unless we're seeing some signs of positive movement. A really good example is climate. It's an area we're engaging a lot on. And this idea of a lot of companies came out and gave these net zero commitments by 2050. And our view was 2050 is not a relevant commitment date. A lot of the folks making those commitments are not going to be in that seat by 2050. And we want to see change sooner. And we want to know 2030. And we want to see data. A lot of the shareholder resolutions we're focused on is data, right? We're investors. So we only are as good as the data. And a lot of the request was, will show us next year in your reporting how you've actually sought to seek to meet those pledges. We want to see CapEx investment in some of these green technologies, for example, if you're a large energy company. We want to see ways you're actually reducing your footprint from a carbon emission standpoint. If it's a broader company, maybe it's a consumer staples or consumer discretionary. And if nothing, and this has happened a couple of times, nothing has been done, or in fact, sometimes it got worse a year end, then yeah, that's the point we would divest. The other driver to divestment can be before any of this happens. We try to engage, or As You Sow tries to engage, or a manager tries to engage, and they won't. That's the other driver. They can often be a divestment or a decision not to invest if it's a new investment, where it's just like, well, yeah, it's a bad actor, and we don't think we're going to be able to affect change. So why are we holding this?
We're now clearly in an era of ESG backlash, at least more in the US, not so much over here in Europe, with the acronym becoming politicized. How do you separate substance from noise in this environment? And how do you coach clients through headline-driven skepticism?
I never mind talking to clients about the headlines that they're seeing. And I remember there was kind of the fever pitch maybe a year or two ago, where sometimes clients would actually bring the physical newspaper to the conversation. And it was oftentimes there were a lot of op-eds that were going around at one point around this. And look, my response was pretty consistent. It was, in some cases, agreeing with what they were reading and saying and admitting that, look, yeah, there is some greenwashing in the industry, or some ESG strategies are political. They're not investment driven. And some are going to be concessionary, and some aren't going to produce impact. And just fully recognizing that and agreeing with aspects of the piece, I think, was both genuine and correct, but also a better strategy than just being totally defensive and saying, oh, it's just media garbage or whatever, And I think it wasn't garbage. There was good reporting there. And I think a lot of it was some of the stuff we were finding, as we just talked about. The second part of it was re-underpinning our approach and saying, here's how we think about it. Again, we have these 4 categories. We're always focused on financial materiality. Here are some of the ways that we're looking at this, and here are the strategies you're invested in them, and why we still have strong conviction in their approach, and how we've tested it over the last year. And that was generally effective. Again, effective because it was genuine. That was actually the read of the articles. And people would send them to me often. I'd say, yeah, a lot of this is true. And they'd be kind of surprised, right? And it was. Some of the reporting was helpful. Frankly, I think a lot of this politicization and backlash is probably a net positive for the industry in the end. I think there's going to be less strategies that are out there calling themselves ESG and are taking broad approaches, and definitely less doing these broad ratings approaches. Maybe less firms in general at this moment offering this, but like the ones that are out there now are much more authentic, much more in line with doing this because it helps them generate better returns, and much more aligned philosophically with why a lot of people are interested in the space. I think it makes the space more durable. I mean, a lot of these firms that jumped in all of a sudden, it kind of hurt the good actors too, if that makes sense. We were lumped into this one big bucket. So was it fun? No. But I think out of what was kind of a very volatile and sometimes painful period, I think we're actually in a pretty good spot around where I see a lot of managers leading right now.
What keeps you awake at night in terms of data and measurement challenges, and what's the biggest gap in impact data?
I do worry a little bit about some of the pullback by corporations on some of these data points that's happening in the US. Certainly, we're seeing a pullback on some diversity related data. In some cases, even some of the climate data that we were getting before has been pulled back. And I think it's a very politically charged environment. And look, I understand why sometimes public companies do this, right? They're managing a lot of risks. I do. I worry about that for some strategies more than others. And I think for us, we do tend to lean towards active management. We do tend to lean towards fundamental approaches that are, direct engagement with management and really understanding a company and understanding what they're doing and how they're thinking about this. And I would say that from our perspective, again, back to the green hushing idea, companies are still incorporating this into their business because they see it being helpful for their bottom line. They're talking about it less, which means data collection is a little bit harder. Some strategies that are purely quant driven is a little bit harder. Again, it depends on the strategy and which data sources you're using. But yeah, generally that. I would say there's pockets of policy that can be challenging from a near-term investment standpoint, but it's important to remember that this is a long-term investment strategy and it's global. Climate's a very good example where people right now are saying, oh, you can't do anything on climate, right? No, that's not true. There are parts of US clean energy that are more challenging than they were last year, but there's still pockets of opportunities within the US clean energy spectrum, and there's plenty of opportunities globally. And remembering that and thinking about that, and also even thinking of things like, okay, well, let's think about time horizon. Even in the US, on some of these challenged parts of the US clean energy spectrum, what if it's a private investment strategy that has a long life and has the ability to weather some of these areas when there's low valuations? Let's think about that. So I think it's just, as always, important to look at the headlines and look at the policy, but then think in a thoughtful way around the nuances and as an investor around how this can still unlock opportunities. But yeah, certainly I think there's aspects that can be worrisome for some sectors.
There's several major trends reshaping the landscape, like AI-driven analytics, new disclosure requirements, and of course, got this massive great wealth transfer happening over the next decades. Which of these do you think will have the most profound impact on sustainable investing and impact investing?
I really am excited about some of the climate related themes that I'm seeing emerging in the investment opportunity set. I think a theme that I would call energy resilience is going to be transformative for the space. I think it's this recognition that, look, we're going to need an enormous amount of energy because of AI and data center expansion. We've all seen some of these figures, but really importantly, when you look at the amount of energy we need and where it will come from, a big part of it is clean. Solar, certainly nuclear, and some of the small fast reactors we get excited about from an investment standpoint, but also natural gas. And I think having a pragmatic approach around energy resilience and really investing in that way around what mix do we think we need to build out energy across types? How do we, again, incorporate clean energy in a way that doesn't put us at risk to over-indexing towards clean energy and suddenly we're in an energy shortage or there's the intermittency problem we've all read about? There's a natural mix here that is really integral to unlock a lot of the AI expansion that we're seeing. Speaking of AI, two is an area I would call responsible AI, which is AI is an enormously exciting technology. It also can be one that we're still figuring out and we're unsure of all the different implications. And we can have some learnings perhaps where around the internet and social media and some of the unintended consequences and some of the things that came out of that. I think we're a little bit smarter now. Already we're seeing, look, AI, again, very powerful, probably a net positive for a lot of industries, but also how do you think about some of the biases it can create by what it's being trained on? I just saw Rite Aid, company Rite Aid, everyone probably knows, was just banned from using AI for the next 5 years in Europe because of misuse of AI for facial recognition to target shoplifters, for example, and some of the biases they were finding. So that hurt their bottom line. And I think that's an important theme around how do we invest in AI, but how do we invest in technologies around AI, whether around how much energy it consumes, around biases being created, around AI fakes. And you've already seen companies come around that are helping understand or almost put a filter on AI to see if it's real or not. I think that's an enormous opportunity. That would be number two that excites me. And I guess the third one broadly I would think about and what I think can be transformational is health and wellness, but specifically within health and wellness, two areas that are really emerging and are very investable and frankly bipartisan are mental health and aging health. You look at demographics and the investable opportunities in an aging population around access to quality healthcare, technology access, stronger access to this idea of isolation that you're seeing in an aging population. How do you fix that? I think that's really important. Mental health is not getting better. It's getting worse, particularly with younger generations. And how do you develop structures and frameworks and technology to help? Those are three big themes that I'm excited about, that I'm spending a lot of time on, that I think will become even more important if you were to talk to me in 2 years, for example.
Mark, I've got a few rapid fire questions for you before we wrap up here. Don't overthink these and give me whatever comes to your mind, or if nothing does, it's okay to take a pass on that too. What's the single biggest myth about sustainability and impact investing?
That you have to concede return to do it.
What would you say is a must-read book or a must-read paper that all sustainability and impact investors should check out?
One, The Key Man. This is a book about a barrage. And for folks that don't know a barrage, I won't spoil the book. Don't believe the hype. Don't believe the amazing sounding impact story without digging into the numbers, making sure it's real and it's sustainable would be the theme of that book. Second, I would say Speed and Scale by John Doerr, one of the most famous venture capitalists of all time, and a terrific book about really the economics behind which technologies can be scaled and can be effective in the climate transition, and which things not to worry about or spend time on that maybe get a lot of press, but aren't actually going to fix it.
The Key Man book was written by who?
It's a good question. I don't know, but you'll find it. It was a pretty big book 4 or 5 years ago. Very well reported.
Name an impact or sustainability buzzword that you would love to banish for all time's sake.
ESG.
Yeah, I think that's been done.
That was easy.
You don't have to name names, but can you describe an investment that you made that you were convinced of at the time you invested? It ticked all your sustainability boxes and all your impact boxes, but in the end, it didn't turn out and went pear-shaped. And what did you learn from that experience?
I mentioned the olive oil one earlier. That was probably the best example. One other quickly, large-scale hydro investment, call it 10 years ago, in the Philippines and Indonesia. Great story, works geographically, lessens reliance on foreign oil. It essentially destroyed the local biodiversity of the environment around it, which was extremely costly to repair, which it was repaired, just for the listeners, but extremely costly for the local environment. Kind of hurt the impact story too. Net impact is the lesson here, even within a theme, which was the E theme in this case.
But what was the lesson learned on that?
Net impact. So when you're looking at an investment, don't get too excited about just the environment or just the social aspects. Look at how all of those work together to create an impact or not. And for this one specifically, frankly, it was two. It was one, even within the environmental aim, think about other environmental effects of a project. But two, this one was a learning of, if you're going to invest in a region, make sure that you are investing with true on-the-ground expertise, folks that have been in that area throughout their lifetimes. And this was an investment that was done by a global emerging markets organization that had offices in a lot of the big cities around the world, but frankly didn't have the locality to really express this. So that was a broader investment learning, frankly.
In your opinion, was that foreseeable? If you had that net impact at that point in time, would have been foreseeable, and you just got enamored with one or the others?
Like anything, Monday morning quarterback, it sounds very foreseeable. I will say that at that time, this is very early on, this idea and formality around net impact expression and negative externalities was still somewhat novel in some parts of the space. But yeah, I think it probably could have been foreseeable, and certainly it's foreseeable now, I'll tell you that.
If someone wants to get into the sustainability and impact investing space, where would you advise them to cut their teeth?
Depends what you want to do, but if you want to do a true investment-driven, non-concessionary role, I would start with a traditional large investment firm that has a rotation program, because I think having the fundamentals around what drives an investment across different areas, that's the only way to be credible. I still walk into rooms and people I can tell are like, here comes this impact person. And me being able to speak their language around IRR and return on invested capital and how we consider risks and opportunities and fundamentals of it, I can see the tone change. And it's like, oh, it's not what I expected. And look, it also just, you need that to make a good investment. But I think it's just really important to also work with clients that think that way.
There he goes again.
Yeah, he's talking about the thing again. But again, if it's framed in the fundamentals of investment, the common language, then it can be effective. And I only say it depends on what you want to do. If you want to do some of the things I was talking about on high impact, place-based, there's different routes to get there. You can work at nonprofits to get there. You can do really interesting international development work. There's lots of different routes. And the one I expressed isn't the only one, but that's my advice. Start traditional.
Mark, I really enjoyed this. I want to thank you for coming on today. We covered a lot of ground here, and I appreciate you going through all of this because, I've learned a lot. And like I told you, I haven't had a lot of wealth managers on, very few actually. And that's different than someone who's running a fund for LPs. It's a whole different ballgame. Now, tell everyone what's the best way they can find out about all the great work that you guys are doing at Glenmede and your website and social media and all that stuff.
Certainly, you can go to glenmede.com. Certainly, you can find us on LinkedIn. You can also just find me.
What's the best way for people to contact you?
Probably my email, or you can look on LinkedIn and send me a message there. But email at work is mark.hayes@glenmede.com.
And Hayes is Hays.
That's right. Thank you.
Like it sounds. And so everyone go to glenmede.com. That's spelled GLENMEDE.com. Lots of good information there. You've got your reports there. So a lot of good information for people.
Our research and thought leadership and everything like that. So
perfect. Well, Mark, thanks again.
Thank you. Great to talk to you.
All right. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.